I'm Richard Hitchcock with the Retirement Center here in Hoover, Alabama. Today we have in our office Kris Moreton of Columbia Management. Columbia is a global multi-billion-dollar investment company with headquarters in Boston, Massachusetts. Kris is a vice president with Columbia who lives in Minneapolis, Minnesota. She heads up their fixed income product team. And since we here at the Retirement Center specialize in retirement-oriented portfolios, and since interest rate sensitive investments are important to us, I asked Kris to tell us what is Columbia's view on the current interest rate environment, what direction interest rates may be going, and what may be happening in the years ahead. Well, we thank you for being here. We're facing some weather today, and we're glad that you could make it. Here at the Retirement Center, we work with people in their growing portfolios and distributing portfolios. As a part of that, we help them understand how they can live on monies that they have set aside. So as we talk about that, Kris, can you help us understand how bonds in our particular investment arena right now are performing and what we might expect in the future?
Sure. I think after last year there was quite a bit of volatility in the bond market. Many investors likely potentially even experienced a loss. The Barclays Aggregate Bond Index was actually down 2%. And so this year, a lot of folks are talking about interest rate risk and what to expect within their bond portfolio. And why are we concerned with interest rate risk? Well, there's a negative correlation between rising rates and bond prices. When rates go higher, bond prices go lower. And so today the question is, where are rates? Am I going to experience more loss in my bond portfolio if rates move higher? Well, the fact of the matter is you might. If rates move higher, bond prices could definitely move lower, and that is the historical relationship. Our view at Columbia Management is that interest rate risk is actually a little muted compared to last year. But last year we started to see signs that growth was picking up. And so the bond market actually doesn't respond very well when growth is better. That's when your equities respond better. So it's this negative relationship between growth and bond performance, interest rates and bond performance, and we have to look at our overall portfolio and see how it's maneuvering through various cycles in the economy.
So at Columbia, how do your portfolio managers work to help mitigate some of that risk?
We are active managers in the bond market. So that means that every day we're taking a look at our overall portfolio, we're evaluating the economic data that's coming out from various sources, and we're positioning to the best of our ability our portfolios to maintain a strong risk-adjusted return in various environments. We have different tools that we can use that day-to-day investors might not have access to. So we are actively looking at the portfolios, at our interest rate exposure, at the individual underlying issuers, and how they may respond to different factors of growth or inflation, deflation, stagflation, and positioning our portfolios to do the best that they can in the economy that we're operating in.
Well, that's excellent. For us at the Retirement Center, so many of our clients are within that short range right prior to retirement, or they're already in retirement. From Columbia's standpoint, how would those type people best position their portfolios when it comes to fixed income?
When it comes to fixed income, we're constructive on a couple of different ideas. One is that you can lessen your interest rate exposure by moving to bonds with a shorter maturity. You can certainly do that as one factor in your portfolio. You can move towards securities that have exhibited less interest rate sensitivity over longer periods of time, such as lower quality bonds. They exhibit less sensitivity to rising rates. In every market, there are pockets that represent value, and it's important to remain diversified, to hold fixed income, even if it might represent a slight loss in your overall portfolio, and know that you're holding it from a diversification standpoint, that when the equity market zigs, the bond market zags, and all together you have to look at the overall total return of your entire portfolio.
Well, that's rather refreshing because 5 years ago that did not happen. That was an anomaly, we all believe. So I think going forward, the average investor, when they look at a portfolio, they would think to themselves that this portion of fixed income in bonds might not have the same decrease in value as it had back in '07 when we had the liquidity crisis. It
Right.
will then, in your estimation, come back to be that kind of a safe haven in the time of a downturn of the equity market.
That's correct. And history shows that maintaining that diversified portfolio of equities and bonds and alternatives, whatever is recommended based on your risk tolerance, diversified portfolios, you might reduce the overall return, but you'll also reduce the overall volatility. You'll enjoy a smoother ride overall as opposed to being 100% in the equity market at all times.
Kris, we thank you for being here and for your insight to what you do and what Columbia is doing.
Thank you so much. Wonderful to be here.
Thank you, Kris, for being with us today. To learn more about what we do and how you can join the conversation, you may go to retirementcenter.us/the Retirement Forum, where you can find more discussions about investment portfolios. You can also connect with us on Facebook and Twitter. Until next time, this is Richard Hitchcock. Thank you for joining us.